US June inflation cools to 3%, but CEO of JP Morgan warns inflation and interest rate may stay higher. Also, Jerome Powell kept emphasizing the Fed needs more confidence to cut rate. Why? As we can see, the US, UK and EU bonds are still crashing since March 2020. In this video, we are going to study the relationship between bonds, yields, and interest rate, which many of us find it confusing. My name is Con Hao. My work in this channel, as always, is to study behavior science and finance, discover correlation between different markets, and uncover potential opportunities. And before we get into this subject, please do take some time to read into this disclaimer. After June CPI, CEO of JP Morgan, Dimon, said there has been some progress bringing inflation down, but there are still multiple inflationary forces in front of us, with large fiscal deficit, infrastructure needs, restructuring of trades, and remilitarization of the world. Therefore, inflation and interest rate may stay higher than the market expects. In this statement, he is referring to the fact that government bonds prices are still under pressure, which is already leading to multiple problems. So, what is the relationship between bonds, yields, and interest rate? And when bond prices are lower, yield will move up. And yield and interest rate influence each other, and when yield is higher, interest rate will pick up as well. Therefore, to understand the direction of interest rate, let's try to work backwards. Why interest rate will remain higher for longer? Because yield will be higher. Then why yield will remain higher? Because bond prices are still under pressure. Then why bond prices are still under pressure? Because investors are not buying them as much, or some maybe even selling them. Then my next question is, why bond prices are lower? Because investors are losing confidence in the country's ability to generate future growth for the economy. And with the continuous borrowings, investors are concerned for the worst case scenario, that is, their ability to fulfill the principal sum at the end of the tenure. And we all know that continuous borrowing or debt will only lead to inflation. Even though it may seem to be taking a breather at this point, but I believe there is a risk that inflation and interest rate trend could be just at its beginning. Now we understand why Jerome Powell needs more confidence with the inflationary data, and why Dimon said there are still multiple inflationary forces in front of us. Because as long as the bonds are under pressure, they may not be able to raise enough money to fund their fiscal spending, infrastructure needs, restructuring of trades, and remilitarization. Then where is the market heading? Let's see our projections some weeks ago on the US markets. Could 21,000 be the next resistance for Nasdaq? How soon it is going to get there, and if there are any risks, market may correct even before or after reaching this target. Yes, it has reached my target. To understand where the markets are heading, try to discern where the bond markets are heading. With the recent election surprises, I believe the bonds will still be under pressure. Because of this, yield and interest rate will remain higher, and stock market should begin to get more volatile for the rest of the year. And I hope that explains why the inflation numbers are cooling off, but the top bankers are saying otherwise. And the central banks keep saying they need more confidence to cut rates. The market are always telling us on their next move. Stay tuned for my coming tutorial. Remember to subscribe to our channel. Feel free to leave me any comments below. I love to exchange ideas with you. Really happy that you stayed through this tutorial. You have Many great trading weeks ahead.